Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 18th of June. I'm Daniel Lam, your host for the podcast. So, the French snap elections that we spoke about yesterday was not the only headline-grabbing news from Europe last week. In fact, the EU announced that it would impose additional tariff on Chinese EV imports, ranging from 17.4% to 38.1% on top of the existing 10% duties, which will come into effect from the 4th of July this year. Now, we do not expect the impact to be so severe. After all, due to their pricing strategies, Chinese EVs should remain competitive in Europe. There's also ongoing gradual increase in demand across the sector as well. Now, having said that, the measures are likely to contribute to a further rise in geopolitical tensions between China and the West. We believe China is likely to retaliate against these European tariffs by imposing tariff on cars imported from the EU. The US presidential elections could also raise the risk of further disputes. So this reheightening of geopolitical risk is coming at a time when, after spurs of hopes of further government support back in the second half of April or the earlier part in May, the newest data remains relatively tepid. For example, Chinese new loans grew from 10.2 trillion to 11.1 trillion RMB in May. That's disappointing expectations of 11.3 trillion RMB. M1 money supply also remained weak. Now, this poor data is partially distorted by financial regulators' attempt at cracking down on bank loans that are seeking higher interest rates through arbitrage. Nonetheless, the persistent downtrend in money growth shows the pressure is on corporate profits and on consumer spending. This also shows up in the lackluster appetite for credit. The total social financing impulse continues to fall on a 3-month moving average basis. Notably, the measure, excluding local government bond issuance, is now minus 1.7% of GDP and is an accurate reflection of the private sector's appetite for credit, as it is not subject to government-mandated loan quotas. So as a result, the Hang Seng Index broke below the key support level at 18,077. And we believe this opens the way for the index to consolidate further. We believe the index is likely to be going into the 17,200 to 17,800 levels in the near term, and there could be some tactical opportunities there when it gets there. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.